While most of the crypto market is obsessed with the Federal Reserve and waiting for Jerome Powell's next interest rate decision, something potentially far more important is happening far from Washington. Quietly and with very little mainstream attention, China appears to be easing financial conditions once again. And that matters far more for Bitcoin than most people realize. China is the same country that banned Bitcoin mining and trading back in 2021. Since then, it's been largely written off as irrelevant to crypto's future. But history tells a very different story. Every major crypto bull cycle has coincided with Chinese liquidity expansion in some form. Recently, headlines began circulating that China had injected as much as $1.5 trillion into its economy. Some claims went even further, suggesting China was preparing to buy up to 1 million Bitcoin. If true, that would be one of the most significant macro events in crypto history. But before jumping to conclusions, we need to separate reality from exaggeration. When you trace the numbers back to their original sources, the picture changes dramatically. The figure most often cited in official reports is not $1.5 trillion, but roughly 1.05 trillion yuan. At current exchange rates, that works out to around $145 billion. Still meaningful, but nowhere near the apocalyptic money printing being pushed across social media. So where did the $1.5 trillion figure come from? It appears to be a combination of multiple Chinese policy tools bundled together. Reserve requirement ratio cuts, targeted lending programs, liquidity support for state banks, and speculative projections were all mashed into one headline number. In other words, this was not a single massive stimulus check written overnight. It was a series of controlled, incremental measures aimed at stabilizing a struggling economy. That brings us to the Bitcoin buying rumor. The claim that China is purchasing 1 million Bitcoin surfaced from a narrow set of sources and quickly went viral. But when analysts attempted to verify it, there were no official statements, no on-chain evidence, and no confirmation from reputable financial institutions. Until wallets are identified or policies are announced, this story remains unverified speculation. However, dismissing China entirely would be a mistake. Even though retail crypto trading remains banned on the mainland, institutional capital is quietly finding legal pathways into digital assets. The key to understanding this shift lies in Hong Kong. In 2024, Hong Kong approved spot Bitcoin and Ethereum ETFs. Initially, expectations were high that mainland Chinese capital would flood in through cross-border investment programs. That didn't happen, largely because retail investors remain explicitly blocked from accessing these products. But retail investors are not the real story. The real development is happening within the insurance sector. Hong Kong regulators are preparing frameworks that allow insurance companies to allocate a portion of their capital into digital assets. This matters because the insurance industry controls enormous pools of long-term capital, measured in tens of billions of dollars annually. Even a small allocation, say 1%, would represent more capital than most retail-driven inflows combined. And here's the critical detail. Many of these insurers are subsidiaries of large mainland Chinese conglomerates. That means Chinese institutional money can gain exposure to Bitcoin through regulated channels without technically violating capital controls. This isn't loud, speculative money. It's slow, strategic, and patient. Now let's talk about liquidity because this is where things get interesting. Most crypto investors track US interest rates obsessively. Every Federal Reserve press conference becomes a market-moving event. But historically, Bitcoin's price has shown an even stronger relationship with Chinese liquidity conditions than with US monetary policy. One of the clearest indicators is China's 10-year government bond yield. When yields fall, it signals easing financial conditions and expanding liquidity. Researchers have found that major Bitcoin price impulses often align closely with these shifts in Chinese bond markets. Why does this happen? Because Bitcoin is highly sensitive to global liquidity. Over long time frames, Bitcoin has demonstrated a very strong correlation with global money supply growth. When liquidity expands somewhere in the world, capital looks for scarce, globally accessible assets. Bitcoin fits that profile perfectly. Right now, China is in a difficult position. Its economy is facing deflationary pressure, a collapsing real estate sector, and slowing growth. Unlike the United States, China cannot afford to keep monetary conditions tight. Liquidity expansion is not optional. It's necessary. And when China turns on the liquidity taps, Bitcoin historically benefits. But liquidity isn't the only signal coming out of China. Despite the 2021 mining ban, recent data suggests China may once again control between 14 and 20% of global Bitcoin hash rate. At first glance, this seems impossible. Mining is banned, so how could this be happening? The answer is that enforcement has evolved. Many mining operations have rebranded as high-performance computing or AI data centers. Others operate under state-linked energy projects designed to monetize excess power, particularly hydroelectric energy in regions with chronic overcapacity. Bitcoin mining is uniquely suited for this role. It can absorb excess energy instantly and convert it into revenue. While the government publicly maintains a hard stance on crypto, it appears increasingly tolerant of mining operations that serve broader industrial or energy goals. This is not a return of retail miners. It looks more like quiet, industrial-scale accumulation of hash rate with state awareness, if not outright approval. Capital flow data supports this broader eastward shift. Trading volume across Asia-Pacific crypto exchanges has surged significantly year over year. Meanwhile, Bitcoin reserves on US-based exchanges are declining, while balances on offshore platforms continue to rise. This suggests that while Western institutions are buying exposure through ETFs, actual Bitcoin liquidity is increasingly moving toward Asian markets. In simple terms, ownership and control are slowly drifting east. However, this story has a darker side. China's economic stress could also create downside risks. In severe downturns, investors and institutions sell what they can, not what they want. Crypto, being liquid around the clock, can become a source of emergency liquidity. There's also the issue of seized Bitcoin. Chinese authorities are believed to hold a significant amount of BTC from past enforcement actions. If the government ever chose to liquidate part of that reserve to stabilize the economy or bail out struggling sectors, the market impact could be substantial. So while stimulus is bullish, the conditions that make stimulus necessary are inherently fragile. This brings us to the final question. Is the next Bitcoin bull market being built in China? The answer is yes, but not in the way people expect. This won't look like 2017 with retail traders piling in through mobile apps. That era is over. This cycle is being shaped by institutional capital, quiet liquidity expansion, state-tolerated mining, and capital quietly seeking protection from a collapsing real estate system. The headlines may exaggerate the numbers. The rumors may stretch the truth. But the underlying trend is real. Bitcoin is a global liquidity sponge. And right now, some of the most important liquidity dynamics are coming from the East.